Could China be headed for a huge property crisis? Now, China's property slump and suffering economy is leading some to wonder if China could be on the brink or on the verge of its own Lehman-style crisis. While the troubles facing China's economy are substantial, it's unlikely to push China into the type of meltdown that sends the country's financial system into a tailspin. Now, the debt that has fueled China's property boom, and as a result, its economic growth has long been a source of concern for long-term investors. They're on the loan, though. Chinese policymakers had been trying to tackle the debt in its economy, a reason they were much more restrained in providing COVID-related stimulus in 2020, and the reason for the property crackdown that sparked the current slump. But policymakers face a bind as a boycott of mortgage payments spread to roughly 300 unfinished projects in 90 cities. Authorities are trying to balance two contradictory goals: one, keeping the lead or even lowering the amount of debt in its property sector, while also supporting property developers to finish projects and avert further social unrest. Prevailing global strategies rise in the node to clients. Now, property developers' debt is piling up rapidly while net income falls. Now, mortgage suspension is a different feature than during past bumps in the housing market, and as for Prasad, former head of China for the International Monetary Fund and currently an economics professor at Cornell University, worries it could constrain developers of even viable projects that end up getting stalled because of the lack of financing. That could create further ripples in the market where housing prices are already slumping and economic uncertainty is high after COVID-related lockdown led to anemic second quarter economic growth. Now, there is no denying the economic risk given that the property market is a major engine of growth. Default could rise as tighter liquidity stresses developers, and some banks could also suffer, though Prasad notes that many are state-owned and the government could easily infuse liquidity, limiting the risk of systemic financial crisis. Plus, unlike the US global financial crisis, the amount of leverage propping up speculative investment is much more limited, and household balance sheets and high savings rates act as a buffer, Prasad says. Now, down payment requirements are also so large that even a significant further decline in prices wouldn't put a lot of mortgages on the water, he adds. A Lehman moment may come someday, but I have come to appreciate how many policy levers they have, Prasad says. We will see lots of stumbles and accidents because of the unbalanced policy responses, but is there going to be a real Lehman moment where the financial system comes apart? I think not. The bigger concern is the hit to the economy. Economists are keeping close watch on how the troubles in the property market seep into consumer sentiment because real estate is a major source of Chinese wealth. A survey by the People's Bank of China of urban depositors 3 years ago found roughly 3 times as many people expected prices to rise as expected prices to fall. But last month, 16% expected prices to rise and 16% expected prices to fall. Though volatile, the survey offers a gauge of sentiments among urban Chinese, and it's clear there has been a major change among how they think about the property market, writes Michael, Peking University finance professor, in a recent note. Now, the troubles in the property market and the economy more broadly could weigh on Chinese stocks. Domestic A shares are trading at a premium to H shares in Hong Kong, and leverage as measured by net debt to earnings ratio is 2 to 3 times higher in mainland China versus the US or even emerging market outside of China, according to prevailing global strategies. Now, in a note to clients, they said the domestic A shares market offers a better short than long opportunity for investors. The iShares MSCI China A shares exchange traded fund is down 17% so far this year, a bit worse than the iShares MSCI China ETF, which is down 15% year to date. China's housing rout isn't like the one suffered in the US during the global financial crisis, and Beijing has a vast toolbox to avoid a Lehman-like crisis, but that doesn't mean it doesn't or it won't be messy.